Welcome to the video on deferred taxation. When we learn about deferred taxation, we need to learn about accounting profit, taxable profits, then what are the permanent differences between the accounting profit and the taxable profits and the temporary ones. Now, the temporary differences between your accounting profit and your taxable profit would create a deferred taxation. So to begin with, let's see what do we mean by accounting profit and taxable profit. Now to calculate the taxable profits, we have a standard performa given to us. Accounting profit is the profit before taxation, which is you take your operating profit, you reduce your finance cost, and you are there with your profit before tax. Now, we would be doing different adjustments to our profit before tax according to the tax jurisdictions to arrive at the taxable profit. First, what we will do is we would remove any income that is taxed under another rule. Then we would remove any income that is exempted from taxation. Later on, we will be adjusting some expenses. The accounting depreciation is not allowed for tax purposes. Therefore, we will be adding back the tax depreciation for the year. Instead, the tax authorities calculate a separate depreciation, which we call as the tax depreciation, and we would remove the tax depreciation from our accounting profits. Then we could have some disallowed expenses, which are expenses that are not allowed under taxation. Now, expenses that are not allowed under taxation could include political donations, entertainment, etc. Right? So, let's do a small calculation and see how this actually works. The following information relate to GTI company. The company is tax resident in Greenland. The corporate income tax rate is 25%. The Greenland tax authorities consider entertainment expenditure and political expenditure as disallowed expenses. Right. So I've already put down the performa. The accounting profit for the year is going to be 150,000. Then you have entertainment expenses for the year, which is going to be $20,000. Now this is a disallowed expense, so we will need to add it back. So we would add back the entertainment expenses of $20,000. Then we have political donations made of 14,000. This is again a disallowed expense. We need to add it back to our profits. So you add back 14,000, which is our political donations. We have income taxed at 15%, $7,000. So this is a tax that is charged under a different rule. So it's income taxed under other laws. So we would remove 7,000 from our accounting profit. The accounting depreciation for the year is going to be 70,000. So this is again similar to a disallowed expense. We are not allowed to take our accounting depreciation for tax purposes. So we would add back our accounting depreciation 70,000. Then we would remove the tax depreciation. This is the depreciation the tax authorities provide us, which is normally referred to as the capital allowance. So the tax depreciation is going to be 60,000. Right. So with this, we will have a taxable profit of 187,000. So our corporate tax rate was 25%. So our corporate tax is going to be 46,750. We have an income tax under a separate law, which is 7,000 into the separate tax rate was 15%. So that's going to be 1,050. So your total tax liability is going to be 46,750 plus 1,050, which is 47,800. Okay, so this is how you calculate the taxable profit and your corporate income tax. Right. Permanent differences between accounting profit and taxable profit arises when the item is not taxed under both the accounting profit and the taxable profit. Now, when you look at entertainment expenditure, when you look at political expenditure and entertainment expenditure is not included in the taxable profit. So that is permanently gone, right? So such adjustments would create a permanent adjustment between our accounting profit and taxable profit. A temporary difference comes when the expense is taxed under accounting profit and also under the taxable profit. Now, the classic example here is depreciation. You see accounting depreciation and there is a separate depreciation which is called as tax depreciation. Now, this will result in a temporary difference. We will illustrate into this further as we go on in the video. SRT purchased an asset beginning of year 1 for $2,000. The asset will have a useful economic life of 4 years and depreciate a straight line method. For tax purposes, the depreciation will be charged using the reducing balance method. The depreciation rate for year 1 will be 40% and increase by 10% each subsequent year. The final year depreciation will be at 100%. Right. So on screen you see me calculating the accounting depreciation and the tax depreciation. The accounting depreciation is fairly straightforward because it's a straight line method and $2,000 allocated over 4 years, so it's 500 each year and we'll allocate 500. Now your tax depreciation for the first year it's going to be 40%, and then on the year 2 and year 3 your tax rate is going to increase by 10% each. So for year 2 it will be 50%, year 3 it will be 60%, and for the final year 100% will be taken. Now the point that you need to note down right here is at year number 4 the net book value of the asset in both the methods, the accounting depreciation and the tax depreciation method, we both have a net book value of 0 at the end of the useful economic life of the asset. When we learn about calculating the taxable profit, we learned that we need to add the accounting depreciation and we need to remove the tax depreciation. Now, if you look at the calculations, I have taken $1,000 as my accounting profit, which is an assumption that I've done for the explanation purpose. I have added the accounting depreciation of 500 on all 4 years. Now my tax depreciation is different. Now since my tax depreciation is different, you see the taxable profit for the year is different as well when compared to the accounting profit. In the first year, I have a difference of minus 300. In the second year, my taxable profit is lower by 100. And in the third year and the fourth year, my taxable profits are higher. So if you look at it, in year 1 and 2, my taxable profit is lower by 400. And in year 3 and 4, my taxable profit is increasing and it sums up to 400. So it looks like the profits that are not being taxed in year number 1 and 2 is going to be taxed in year number 3 and 4, right? So you see that the difference between the profits, right, they get settled off or they get eased out as the time passes, right? By the end of the fourth year, there is no difference. The differences are settled, right? So these are temporary differences, and temporary differences give rise to deferred taxation. Now, when you look at your taxation without doing any adjustments, your taxable profit for the year is going to be 700, 900, 140, 160. You see, it's different. The reason of the difference is the difference in the depreciation. Now, under accruals, we are required to consider the total expense related to the period. Now, due to the tax authority's adjustment, I'm not considering the entire depreciation when I take my taxable profit. So, deferred taxation is actually required by the accruals concept so that we could match our income tax expense to our actual accounting expenses. Now, if you look at this tables that are shown to you, you have the differences highlighted here, right? Your accounting profit was 1000 in the first year, taxable profit was 700. So your profit is lower by 300. In year 2, your profit is low, taxable profits are lower by 100. In year 2 and 4, your taxable profit is going to be higher in year 3 by 140. And in year 4, your taxable profit is going to be higher by 260. So now what we'll be doing is I'll look into these differences and I'll adjust for these differences under my taxable profits to calculate what is going to be my corporate taxation. So you see on the second table, I've taken the taxation based on my taxable profits. To that, I have adjusted the difference. So the first one, my taxable profit was lower by 300, so I add that 300 so I can eliminate the difference. In the second year, it was lower by 100, so I added that 100 to eliminate the difference. In the third year, it was higher by 140, so to eliminate that difference, I remove 140. In the fourth year, it was again higher by 260, so to eliminate the difference, I'll remove 260. Right? So then when you look at it, my taxable profit and the accounting profit are going to be the same, right? It did an assumption where our accounting profit was 1000 and we have arrived at that 1000 itself, right? And then I'll be charging 25%, right, as my income tax, and I'll be charging 250 throughout the year. Right, so there is no difference. So I have taken the entire tax expense related to my asset according to the accruals concept. Right, so deferred taxation is about looking at the difference and then you adjust for that differences. Okay, right. You have a standard working for deferred taxation to calculate the temporary difference and the deferred tax resulting from the changes in your asset values or your net book values. So the standard performa is you start with your accounting net book value, which is the net book value according to our accounts. We take our accounting depreciation and take it. From that we remove the tax carrying value or the net book value according to the tax authorities. Then you would get your temporary difference. That temporary difference is going to be multiplied by the tax rate and you would get your deferred tax amount. Okay, right. So now let's look at a calculation on deferred taxation. Now this is actually developed on everything that we have been talking so far on the example we have taken. So if you have any doubts about any figures, you can always go back to the video, see how they were calculated. Now, we were given a standard performa that needs to be followed when we calculate the deferred taxation. We need to take the accounting carrying value. From that, we need to remove the tax carrying value. So, in year 1, my asset has the accounting carrying value of 1500. Second year of 1000. Third year of 500. Fourth year, nil. And then I have my tax carrying value. Now my tax carrying value is 1200 in the first year, 600 in the second year, 240 on the third year, and nil in the fourth year. So you see the temporary difference being calculated here. The temporary difference is going to be calculated by your corporate tax rate, and you will get your deferred tax for the year, right? So for the first year, your deferred tax account will have a balance of 75. In the second year, your deferred tax will have a balance of 100, right? So now if you look at the last one here, you see that 75 was the change in the first year, 25 was the change in the second year. Altogether, it's 100. And then it gets paid off in the third and the fourth year. 35 in the third year, 65 in the fourth year. So what happens here is I am basically collecting the future tax payables, right? Because of the temporary difference in the first and the second year, I'm paying it off in the third and the fourth. So in the first year and the second year, since these are to be payable in the future, these are going to be liabilities, right? And in the third and the fourth year, this liability is going to get settled off, right? Okay. Now your taxable profit for the year, it's again given to us in the question. That's 700 in the first year, 900 in the second year, 1140 in the third year, and 1260 in the final year. So your taxable profit into your corporate tax rate of 25%, you will get your corporate tax. Then you need to look into your deferred tax adjustments, right? Now, if your deferred tax is increasing, that basically means that your taxable profits were lower, your tax is computed less, right? So to adjust for that, what we need to do is we need to add the deferred taxation, right? So I would add the deferred taxation, the change of 75 if it increases. Second year also it's increasing by 25, so I would add the value. Then on the third year, right, you see my taxable profits were higher compared to my accounting profit, right? So I need to reduce my taxable profit or my taxes, right? Therefore, if I'm looking at a reduction here, right, on my deferred taxation, I will reduce it from my income tax for the year. So I'll reduce 35 and I'll reduce 65. So you see your income tax is going to be 250 throughout the 4 years, right? So we have eliminated the temporary difference. Okay. Now that we looked into the computations, let's look into double entries. So as I mentioned earlier, deferred tax, if it is increasing, it's a liability, right? So when a liability increases, you need to credit it. So what you'll be doing is in the first year, you would credit your deferred tax account by 75, and then your income tax account, see your expense, what is happening is your income tax expense is increasing because of the deferred tax. So your expense is increasing means you need to debit it, so you'll be debiting it by 75. Okay, so in the second year, you'll be doing is you will be debiting your income tax account by 25 because that's the change, that's the increase, and your deferred tax account would get credited by 25. So we only account for the change in the deferred taxation, right? And then when the deferred tax decreases, your liability is being paid off, right? It gets settled off in the third and the fourth year, right? So when your liability settles, you need to debit the account. So you'll be debiting the account. And in year 3 and year 4, in year 3 and year 4, what happens is you will be debiting your deferred tax account by 35 and 65, and your income tax reduces when your deferred tax reduces, right? So you will be crediting your income tax account by the deferred rates, right? So guys, do remember, right, the deferred tax adjustment, the amount that you see here, right, under the deferred tax adjustment, this is going to be the balance of your deferred tax account. This will be shown in the statement of financial position. If this account has a credit balance, that means it's a liability, then it will be shown under non-current liabilities. If this account has a debit balance, then that means you are looking at an asset, then it will be shown under non-current assets. Your income tax, right, this amount of 250 is going to be shown in the statement of profit or loss. Okay, right. So that's going to be your adjustments that you'll be seeing in, right? Your total income tax will be shown in your statement of profit or loss, right?